Lucid Group Inc. is currently trading at $5.90 during this intraday session on Tuesday, April 28, 2026, marking a sharp decline of 5.60% from its previous close. While the broader market shows mixed signals, Lucid is essentially fighting a gravity-defying battle against its own internal burn rate and the harsh reality of a saturated luxury EV market. The stock has touched a fresh 52-week low of $5.93 today, effectively wiping out the optimism that briefly flickered during the morning bell. Most people look at a drop like this and see a failing car company, but the reality is much more complex. We are seeing a fundamental shift in how the market values high-end electric vehicle manufacturers. It is no longer about the beauty of the design or the impressive range of the battery. It is about who can survive the next 18 months without another massive round of dilution. If you look at the order books for the Lucid Air, they are steady, but steady doesn't pay for the massive manufacturing overhead in Arizona and Saudi Arabia. The surprise here isn't just the price drop, it's the volume. We are seeing millions of shares changing hands, which suggests that institutional players might be rebalancing their portfolios, moving away from high-risk growth and into safer havens. The common belief among retail investors is that the Saudi Public Investment Fund will always be there to write a check. People think Lucid is too big to fail because of its sovereign backing. However, the contrarian view is that even sovereign wealth has its limits of patience. The recent appointment of Silvio Napoli as CEO and the expanded Uber partnership are attempts to pivot the business model toward a software-defined fleet future. But that transition takes time, and time is a luxury Lucid doesn't have in a high-interest rate environment. When you look at the Lucid stock performance over the last month, down over 33%, you realize the market is pricing in a very different reality than the one presented in the glossy investor decks. The daily swings we've witnessed recently are a testament to the tension between those betting on the upcoming Gravity SUV and those terrified of the cash burn. Just last week, we saw a nearly 10% drop in a single day after reports surfaced regarding increased competition from established luxury brands. Institutional activity has been particularly telling. Large blocks of shares are moving, and while some see this as smart money accumulating at all-time lows, others see it as the final exit for funds that can no longer justify the volatility. If you are using platforms like the Robinhood app or SoFi Invest to track these movements, you'll notice that the sentiment score has plummeted to extreme fear. Trading volume today is significantly higher than the 10-day average. This often happens when a stock breaks through a major psychological support level, in this case the $6 mark. Once that floor gave way, stop-loss orders on brokerage platforms like Fidelity and Interactive Brokers likely triggered a cascade of selling. This is the reality of self-investing. The technical indicators often dictate the short-term pain regardless of the long-term vision. We are seeing a significant amount of short interest as well, with traders betting that the price will continue its descent toward the $5 handle. Let's talk about the business itself for a moment. Lucid isn't just making cars. They're trying to sell an entire ecosystem. Their business model relies on the mid-size platform, which is supposed to launch in late 2026. This includes the Cosmos and Earth SUVs, which are aimed at a much larger market than the $100,000 plus Air sedan. The idea is to use their superior efficiency, getting more miles out of a smaller battery, to undercut the competition on price while maintaining a premium feel. It's a solid plan on paper, but the execution risk is massive. They are currently losing thousands of dollars on every car they produce. That is a weight that even the most innovative software-defined architecture has trouble lifting. Recent earnings reports show a net loss that continues to widen even as revenue ticks up. This is the classic J-curve problem, but the bottom of the J is looking very deep. The company's cash position was recently bolstered by a $1.05 billion investment, which provides some breathing room, but at the current burn rate, that's less than a year of operational runway. Investors are now looking at every delivery number with a magnifying glass. Every single car counts when you are trying to prove to the market that you can scale. Comparing this to the Nvidia stock or Apple stock trajectory is almost unfair, but it highlights the difference between companies that have already achieved escape velocity and those still on the launch pad. While those tech giants are generating massive free cash flow, Lucid is still in the phase where it must spend billions to potentially make millions. It's a high-stakes game of poker, and the other players at the table are global giants with much deeper pockets and existing supply chains. Comment below how many shares of Lucid Group you currently hold, or if you've moved your capital into safer ETFs recently. I want to know if you believe the Uber robotaxi deal is enough to save the brand. Looking ahead, the catalysts for a turnaround are clear, but they are all late-stage events. The launch of the Gravity SUV later this year is the big one. If that vehicle receives the same critical acclaim as the Air, but actually translates that into high-volume sales, the narrative could shift overnight. However, the risks are equally clear. If there are production delays or if the demand for luxury EVs continues to soften globally, the company may be forced into even more aggressive dilution, which would be devastating for current shareholders. The macroeconomic pressures are not helping. With persistent inflation and high borrowing costs, the aspiration buyers, people who might stretch their budget for a luxury EV, are disappearing. This leaves only the ultra-wealthy, a segment that is notoriously fickle and already well-served by brands like Porsche and Mercedes-Benz. Lucid's struggle is to convince these buyers that its technology is so vastly superior that it justifies switching from a legacy brand with a century of prestige. In the final analysis, the expectation was that Lucid would be the Tesla killer, a company that could combine Silicon Valley tech with true luxury craftsmanship. The reality is that building a car company from scratch is perhaps the hardest task in modern business. The company has the best engineering in the world, hands down. Their motors and battery management systems are years ahead of the industry. But engineering doesn't always win the stock market battle. Manufacturing efficiency and capital management do. If you are looking for investment help or exploring various investing sites, you have to decide if you are a technophile who believes in the product or a realist who looks at the balance sheet. Those who use Schwab Intelligent Portfolios or automated robo-advisors are likely seeing very little exposure to LCID right now because of the risk profile. For the individual brokerage user, it's a question of whether you believe the current price represents a generational buying opportunity or a falling knife. The contrast between expectation and reality here is stark. Investors expected a smooth ramp-up and a clear path to profitability by now. The reality is a grueling fight for every percentage point of market share in an environment that has become hostile to unprofitable growth companies. As we move through 2026, the success of the midsize platform and the integration of the Uber fleet will determine whether Lucid becomes a dominant force or a case study in the difficulty of automotive disruption. To wrap this up, we've seen Lucid Group struggle today at the $5.90 level, hitting new lows and testing the patience of even the most loyal backers. We explored the deep financial losses weighed against the genuine technological leads the company holds. We looked at how institutional selling and technical triggers on platforms like Fidelity and Interactive Brokers are driving the current price action. The reality of the situation is that while the cars are brilliant, the business is in a precarious state, relying heavily on future catalysts like the Gravity SUV and the Uber partnership to bridge the gap to profitability. The depth of this analysis suggests that while the upside is theoretically high, the path to reaching it is fraught with more danger than most are willing to admit. The story of Lucid remains one of the most compelling in the market because it pits pure innovation against the cold, hard math of industrial manufacturing. Whether you are trading through a Robinhood account or managing a complex portfolio through wealth management services, the lesson remains the same. Technology is the engine, but capital is the fuel. Without enough fuel, even the most advanced engine in the world won't get you to your destination. Watch this breakdown of the Lucid Investor Day 2026 strategy. This video provides an in-depth look at the company's official roadmap for the next 2 years, including the specific technical details of the midsize platform mentioned in the analysis. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.